In this video, we will discuss property and casualty insurance provisions. These provisions include conditions that stipulate how disputes between the insured and insurer will be resolved, how policy limits will be applied, the duties of both the insured and insurer under the policy, and how losses will be paid. These provisions include conditions that stipulate how disputes between the insured and insurer will be resolved, how policy limits will be applied, the duties of both the insured and insurer under the policy, and how losses will be paid. Failure on the part of either party to comply with the provisions listed in an insurance contract may result in the denial of a claim, rescission of the contract, or even legal action. Let's look at some of the common terms you'll need to know. The named insured is the primary policyholder listed on the declarations page. They have full rights under the policy, including full coverage, ability to make changes, premium and cancellation rights, access to all policy benefits. How limits apply: the named insured has access to the full policy limits. If a policy has a $1 million liability limit, the named insured can receive up to the entire limit for a covered claim. Example of named insured: RC Copy Service buys a business owner policy, BOP. RC Copy Service is the named insured. They own the policy, control it, and are protected up to the full policy limits. First named, first listed, holds contractual rights. Additional insured, third party added due to insurable interest. A company that leases property, like Global Copiers Incorporated, may be added as an additional insured on the lessee's policy, so they're protected if the item is damaged during the lease. Similarly, mortgage companies and lenders are added as additional insureds to protect their financial interest in the property. Other insureds, not listed, but covered under certain conditions. Guests staying at your house. Please note that this scenario does not apply to guests who rent space in a home or to boarders unless they are family. Policy period. Coverage applies only during the listed policy dates. Policy territory defines the geographic area where coverage applies. Deductibles. Amount the insured pays before coverage applies. May be risk retention, chosen, or risk sharing required. Example: Belinda has a homeowner's insurance policy with a $1,500 deductible for physical damage her home sustains. When a tree limb falls on her house and causes $1,400 of damage, she is not able to file a claim because the damages have not met her deductible amount. From an insurer's viewpoint, using deductibles keeps the cost of insurance lower because money is saved when covered losses are small and do not require the carrier to investigate the loss or pay any money on the claim. The insured, on the other hand, should consider using the deductible as a premium management tool, allowing them to select a premium based on their ability to pay first dollars on any loss experienced. Deductibles are often expressed as a specified dollar amount, i.e., $500, $1,000, $2,500, etc., but can sometimes be indicated as a percentage of the coverage total of a structure. Example: in an earthquake endorsement, the deductible is usually from 2% up to 20% of the building or dwelling coverage limit, depending on how close the structure is to the nearest earthquake zone. Exam tip: deductibles may also be viewed as a form of risk management, but which risk management technique is being employed depends on the circumstances. If the insured is able to choose their deductible amount, then the deductible is acting as a form of risk retention. The insured is choosing to retain a certain amount of risk equal to the amount of deductible they choose. Now let's look at cancellation and non-renewal. Cancellation means a policy ends early, before the expiration date stated in the declarations. Insurers earn their premiums as the policy period progresses toward the policy expiration date. The insurance company will refund unearned premiums either on a flat fee, pro rata, or short rate basis, depending on whether the cancellation was initiated by the insured or the insurer. Exam tip: make sure you understand the difference between pro rata, short rate, and flat rate refunds of unearned premium, as well as under which circumstances each one is used to calculate the amount of an insured's refund in the event of policy cancellation. If the insurance contract is rescinded, then the insurer must issue a flat rate refund. When the insurance company cancels a policy, the insured receives a pro rata refund. If an insured initiates a policy's cancellation, then the insurer is only required to pay a short rate refund. Non-renewal occurs when insurer chooses not to continue coverage after expiration. Exam tip: be alert on a state insurance exam if you see questions addressing the number of days required for prior notice of non-renewal. The number of days allotted in the generic policy form often differs from the number required under a state's insurance statutes. If your exam integrates state-specific content with general topics, assume the correct answer is the state-specific number required by law. If your exam segregates law questions into a separate chapter, as is the case in the majority of state exams, the correct answer in the general section is the general answer, and the state-specific response applies when a question is asked during the law section of the exam. Lapse is when the policy ends due to failure to pay premium. Grace period is the extra time to pay late premiums without loss of coverage. Now that you understand the general terms, you are ready to learn more about property policy limits and calculations. Click the next video to check it out.